Hey guys, are you thinking about buying a home but confused about mortgages? Then let's break it down piece by piece. First of all, what is a mortgage? A mortgage is a loan specifically designed to help you buy the home. It is a way to spread out the cost over the next 15 to 30 years instead of paying it all up front. So when you take out a mortgage, you basically borrow the money from a lender and promises to pay it back with interest. If you fail to keep up with the payment, the lender can simply take the ownership of the property. So let's break down the key component of a mortgage. Principal, interest, taxes, and insurance, also known as PD. So first up is principal and interest. Principal is basically the money you borrow, and interest is the cost of borrowing this money. For example, you bought a $300,000 house with a $60,000 down payment. Then the remaining $240,000 would be your principal. That's the money you borrowed. And interest is the cost of borrowing this money. And interest rate are decided by various factors such as your credit score, current market rate, the money you borrowed, and a lot of other stuff. And in the beginning of your payment, your majority of your payment would go toward your interest and very little will go to your principal. But over time, more will start going toward your principal. That's where it helps you build up your home equity. Then comes taxes and insurance. They both are included in your mortgage, your monthly mortgage. The basic reason they both are included in your monthly mortgage is to protect the lender. So, for example, taxes are viewed as the uppermost priority lien. If if with a $300,000 house, you had a $200,000 taxes that you haven't paid, and they foreclosed on your property and sold your property for $300,000, then from that $300,000, $200,000 will go toward the taxes, and the remaining $100,000 will go to pay the lender, and the lender cannot come after you for the remaining $140,000. That's why the lender like to make sure you pay your taxes. And the same about the same thing with the insurance. If, for example, your house get destroyed by a natural disaster and you don't have an insurance and you don't have the money to repair it, then you are at an advantage. You can just file a bankruptcy and leave, and the lender is left with a $60,000 property. So that's where the lender like to make sure if anything like that happen, then it's the insurance problem, not the lender.